In this video I'll walk you through an easy to follow Parabolic SAR indicator strategy with a high success rate, so without wasting time let's jump straight into it. But before we proceed, don't forget to tap the like button to support us and subscribe to the channel if you're visiting for the first time. See you right after the intro and disclaimer. The Parabolic SAR, also referred to as the Parabolic Stop and Reverse, is an easy-to-use trend-following indicator that effectively helps in identifying both entry and exit points. First, let's add it to our chart. Go to the Indicators tab, search for Parabolic, and choose the one labeled Parabolic SAR. Now when it comes to settings, I personally stick with the defaults, and here's how it appears. Once applied, you'll notice a series of dots placed either above or below each candle. The way to interpret this indicator is quite straightforward. When the dots form beneath the candles, it suggests that the market is currently trending upward, but if the dots appear above the candles, it signals that the market is in a downward phase. The gap between the dots and the candles also gives insight into the trend's strength. The greater the space, the stronger the trend. Now let me give you an example. As you can observe here, the dot appears beneath the candle, showing that the market is currently in an uptrend, and as this uptrend begins to strengthen, you'll notice the gap between the dot and the candle expanding. Then as the bullish momentum begins to fade, that space between the dot and the candle starts to shrink gradually until eventually the dot flips to above the candle, signaling that the trend direction has reversed to the downside. Now let me walk you through several strategies you can apply using the Parabolic SAR. The first one is a popular approach often used by novice traders, where they enter long or short trades solely based on the dot's placement. For instance, if the dot flips below the candle, they open a long trade, and if the dot appears above the candle, they go short. Although this method is widely known, it comes with a few issues when used this way. First of all, the Parabolic SAR is designed as a trend-following indicator, which means it performs best in trending conditions. Keep in mind that markets don't always trend, they can also move sideways, and since the Parabolic SAR continuously generates signals, it will keep doing so even during ranging markets. Let me give you an example. In this case, we can see the Parabolic SAR flips below the candle, suggesting that the market is in an uptrend, and based on the strategy we would enter a long trade at this point. Then we notice the trend fades and the market begins to consolidate sideways, but take note that the Parabolic SAR continues to show entry signals even though the trend has already ended, and as a result all the signals generated during this sideways movement end up as losing trades. So to summarize, the Parabolic SAR functions well only in trending conditions. If the market is ranging like this, it will trigger multiple false entries. The second issue with using the Parabolic SAR in this way is that it ignores the overall long-term market trend. Let me break that down. Suppose you open a short trade at this point because the Parabolic SAR shifts above the candle. Now if you zoom out and observe the bigger picture, you'll notice that the overall market is actually trending upwards. So entering a short trade here based solely on the Parabolic SAR would mean you're going against the broader trend, which is generally not advisable. That's why the better approach is to combine the Parabolic SAR with another indicator that can help identify the long-term direction. One such indicator is the 200-period exponential moving average. Here's how the complete strategy works. The first step is to determine the long-term trend, and you do that by checking where price is in relation to the 200 EMA. For instance, if price is trading above the 200 EMA, it signals a long-term uptrend, and if it's trading below the 200 EMA, it points to a long-term downtrend. Once you've identified the primary trend, the next step is to wait for the Parabolic SAR to confirm it. For example, in this case the price is below the 200 EMA, signaling a downtrend, which means we wait for the Parabolic SAR to also turn bearish by appearing above the candle. At that point you'd enter a short trade. The same logic applies for long trades as well. Here we can see the price is above the 200 EMA, confirming an uptrend, so now we wait for the Parabolic SAR to also turn bullish by forming below the candle, and when that happens we go long. So by including the 200 EMA in your system, you can now trade the Parabolic SAR with more confidence while staying in line with the overall trend. Moving forward, aside from using the Parabolic SAR for trade entries, you can also apply it as a tool for exits, and one of the most common exit methods traders use is simply waiting for the Parabolic SAR to flip positions. Here's a quick example. You'll notice that the price is trading above the 200 EMA while the Parabolic SAR is below the candles, which according to the method would be a valid long setup for your exit plan. You'd let the position run until the Parabolic SAR shifts to the opposite side. Once it does, that's your cue to exit the trade. However, you'll notice that by the time the SAR flips, the price has already dropped dropped significantly, meaning you've given back a portion of your gains due to the delayed signal. So what if there's a more efficient way? Let's rewind that trade. Instead of waiting for the SAR to change sides, you can place your stop loss directly on the parabolic SAR level. So if you take a long position here, you can position your stop just below the SAR point, and for your take profit you can aim for 1.5 times your stop loss value. Then you simply let the trade unfold until one of the targets is hit, and as you can see, this method leads to an earlier exit compared to waiting for the SAR to flip positions. Now sometimes the parabolic SAR might appear quite far from the candle, like in this example here. The SAR is way below the current price level, meaning that if you used it as your stop loss, you'd be risking a much larger amount if the trade fails, and in those cases you can fine-tune your stop placement based on how much risk you're comfortable taking. Now on to the next high probability setup using the parabolic SAR, and that is spotting divergences. First off, what exactly is a parabolic SAR divergence? It's when the price moves in one direction while the indicator moves in the opposite. Let's look at a sample case. Typically when price trends upward, the SAR also trends upward, and when price moves down, the SAR moves down too. But sometimes you'll notice the two moving differently, like in this scenario, the price is falling while the parabolic SAR is climbing upward. This mismatch is known as a divergence, and it often hints at a possible continuation of the trend, which may present a trade setup. So here's how this strategy is implemented. The first thing you need to do is identify a divergence, and to make spotting one easier, I usually switch my chart type to a line chart. Next, you should look for moments where the parabolic SAR is moving in the opposite direction of price movement. Like in this example, we can see the parabolic SAR is trending down while price is pushing upward. This creates a divergence. Now the question is, how do we determine whether this is a bullish or bearish divergence? The answer lies in the price direction during the divergence formation. In this case, the price is rising, which tells us that it's a bullish divergence. Next, you'll need to wait for your entry confirmation. After spotting the bullish divergence, you confirm upward momentum by waiting for the parabolic SAR to flip below the price. When that occurs, it's your signal to open a long trade. Your stop loss can be placed at the parabolic SAR, and your profit target can be set at 1.5 times that distance. Now let's walk through another example. In this scenario, the parabolic SAR is rising while the price is falling, so we've identified a new divergence. This time, because the price is dropping during formation, it's a bearish divergence. For confirmation, wait until the parabolic SAR flips above the candle. When that happens, you take a short trade, place your stop loss at the parabolic SAR, and aim for 1.5 times your stop distance as your profit target. And as shown, this position turned out to be successful. Now, as you may know, the crypto market has recently started trending again, which makes it a great time to use the parabolic SAR for trade setups. That's all, traders. Thanks for watching. I hope you found value in today's video. If you did, don't forget to hit that like button. It truly helps support the channel. And if you're new here, make sure to subscribe and turn on the notification bell so you never miss any future content. Thanks for watching, and I'll see you in the next episode.